Now, Nigerian banks will have to evolve rapidly in the face of increasing disruptions brought about by technology from non-bank institutions in the country and around the world. That was one of the key focal points of the panel, comprising of economists, market professionals and analysts at the launch of the latest Tier 1 Banking Industry Report, unveiled on Friday by Proshare. The panelists also discussed financial deepening, Apex Bank cash reserve ratio requirements, as well as regulation and risk management. Let's take a quick listen.
The Nigerian economy is on a reset. And I say that deliberately because when we look at the historical pattern with our economy from 1961 till date, can put it in 10-year planks, then two particular decades stand out. And that is 1981 to 1990, then 2001 to 2010. Now, why do I pick out those two? 81 to 90. For the decade, we had a negative average GDP growth rate. And that was about 0.18%. And then 2001 to 2010, we had the highest average GDP growth rate of about 7.87% annual average. Now, what were the peculiarities? Why did we have negative growth rate in those years? Now, the few issues that we can pick out are, number one, that was a period Nigeria became a nation that got entrenched in economic rent behavior. Secondly, corruption took a new turn, and then we saw a lot of leakages, all right, in fiscal operations of government. Also, within that period, we lost an opportunity to reform the economy. We tentatively started with SAP, but unfortunately we embarked on what we term as policy reversals, and of course instability over that period of time. But when you now look at 2001 to 2010, that was the period we reformed the economy, and then everyone began to see Nigeria as a possible destination for investment. That was also the period when Nigerian banking took a new turn, in the sense of growth and the sense of what we might call agility.
We realize that there's competition in the space. And while previously the competition we'll be looking at is the banks within ourselves. But interesting, in recent times, we've seen that the fintechs have actually begun to play a very significant role in our space. And what that means is they run a very lean model in their operations. And so as banks, what we start asking ourselves to make sure the cost-to-income ratio makes sense to us is, one, how do we ensure if the revenue is not even growing, because now we have to share the pie, how do we reduce the cost to become a lot more efficient? So there are lines of cost that we look at as an industry. And for some reason, all eyes of the banks are on costs now, operational expense, a lot now, operating expense in that space, whether on the staff side or on the other operating expense. And also away from that is also us asking ourselves, how do we replicate the model of the fintechs? How do we operate a more lean model? With the fintechs, one space they operate well in terms of revenue is their non-interest revenue, because they're quick to come to market. The speed in which they act is extremely important. So you see banks investing in technology to reduce the cost of operating so they can grow the revenue. You need to employ like 20 people to reach out to 2,000 people. But for some reason, your phone can get to those 2,000 people if you have the right technology. So you see that strong focus in the industry on digitalization, which has become extremely important for us. But also away from that is also looking at our balance sheet. Now moving into efficiency of your balance sheet to say, how do I operate a capital light play? It becomes extremely important because the cost of, that's what feeds into cost of risk. The lighter you are in ensuring that the quality of your loans are high and you have efficiency in terms of the performance of your loan, but play more in the space of non-interest revenue, that revenue grows, even though your cost as well, you're paying attention to. So we tend to play more in the space of non-interest revenue. And so I'm sure in your analysis, you tracked a lot around the non-interest revenue of banks, which is the digital income that was spoken to on the report. So a lot of banks now, you see in the holdco structure, it's just really to compete in that space of non-interest revenue. And more, all our eyes are on those balls, not only in terms of the cost-to-income ratio, but also the efficiency we see in terms of our balance sheet.
So I think for banks, your emphasis should be, how do we continue to adopt technology? How do we continue to disrupt ourselves? That's why when you saw that the bank's income are actually diverging from fund-based to fee-based. And the beauty of the fee-based activity for the banks, the key thing for banks, that they have to integrate technology into their main service platform. They now need to begin to see themselves as not an institution that just go to the central bank to get a license to operate deposit and savings activities, but an institutions that primary responsibility is to provide financial services to the discerning public. And this process will no longer require anybody coming to the banking hall. I can't remember the last time I went to the banking hall. So technology is going to provide that platform, and banks must self-destruct their current structure, so adopt a new structure to survive. How does this affect shareholders? Or how does this affect the valuation of banks? If you look at the Nigerian capital market, as at the close of business yesterday, market capitalization was 36.6 trillion naira. The banking industry capitalization was 5.58 trillion naira. The banking industry accounts for about 15% of market capitalization. But if you look at the banking industry as a share of the Nigerian economy, its share of the Nigerian economy is just about 4.77%. Because the financial and insurance industry accounts for about 5.26% of the Nigerian economy. And the banking industry accounts for 90% of the financial institutions and insurance. So if you do the arithmetic, banks account for just about 4.7% of the GDP, but account for 15% of market capitalization. Why is this so? It is so because the Nigerian banks have seen the highest level of adaptation or adjustment when it comes to the African banking industry. And we've seen a shift, a material shift from what we used to be to what we are today. I don't think there's any sector, any country in this Africa that has a banking industry adopt technology the way Nigerian banks have done. And that is reflecting in their performance. And investors are bidding for that performance. So I think for banks that are adept at transformation, which is why when you talk of your changes or modification of your categorization of the banks, and you're shifting away from just an asset-based bank, and I can tell you, I'm beginning to see banks that are very nimble in technological adoption. There's one new bank of all the newly licensed banks that were licensed in the past 4 years that has provided its platform almost everywhere. They just went national about a year ago. This bank was licensed about less than 5 years ago. They got national just a year ago. But if you go to any trader, any merchant, you find that their payment platform is what most of them have adopted. So adoption of technology will begin to be a major metric to determine where banks will be in the near future. And that will drive their performance in terms of income and return to shareholders.
For you to be able to quantify and assess their risk, you would require a certain level of capital to venture into those risks. And like we said, you can see that the structure of banking is changing. Even on the stock exchange, when you look at the banking sector, for you to capture that impact of banking, you need to look at financial services because of the holding structure that most of those banks are now taking that position to tap into other business and give flexibility to the banks. They go into those different areas. Looking at what happened, we still recall the 2007-2008 we called tsunami in Nigeria, bank tsunami that impacted on the banks. You would see that for most of the banks that went under then had a lot of other subsidiaries that impacted on their profitability. Before regulations now came that they had to break away and sell those subsidiaries. Now it's like we're going back into that structure, holding structure, to give that flexibility, which means that risk management has to be stronger. The capital requirement now is better compared to before. When you look at the capital adequacy ratio for the banks, is higher, but there's a need to have close monitoring on those banks so that we don't have a repeat of what's happened then. So the way I will wrap it up is that the adoption of Basel III, which when you look at the threshold, the capital adequacy requirement at 8%, I believe that for Nigerian banks, we are well more capitalized than that level. And if we also want to look at the capital adequacy ratio in dollar terms, that is where we know that if the benchmark is in dollar terms, there will be need for additional capital. But we don't operate mostly in dollars. So I would say that the focus now is for the new leadership of the CBN to see how they can allow banks make effective use of even the available capital. We see cash reserve requirements at 32.5. Yes, for merchant bank now at 10%. Why do we want to keep that amount with the CBN? Because indirectly it impacts on the lending rate. If I'm collecting 100,000 from a customer and I can't generate income on 32%, it means I will sweat the remaining 70% to be able to cover the cost for the other 30%. And as a result, lending rates will be high because they need to cover all those costs vis-a-vis some of the other charges. So it's important that there's close monitoring. I won't recommend an increase in capital requirements now. The focus should be financial discipline.
The need or the growing shift to increase the structure to getting other non-banking subsidiaries onto the holding structure. It is very important to pay key attention to the risk assessment and risk management, especially because the banking subsidiaries still account for the largest percentage of the total holdco structure, whichever way we see it. So now there could be these ripple effects from whatever economic shock that happens to the banking sector. So it's important for the management of the banks to properly manage risk, properly effectively monitor the risks in order to be able to curb the shocks from respective either the banking subsidiary or the other non-banking subsidiaries.